Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Klea Papadhima, Corporate Solutions Analyst with Nasdaq, to discuss the Chinese economic landscape and opportunities for investment. Klea, it's great to have you with us. Welcome to Trade Talks.
Thank you so much for having me.
What are some of the key developments that have formed the Chinese landscape this year?
All right, so firstly, we saw increased regulatory oversight and constraints regarding discussions between Chinese and US regulators on audits which lack compliance with the SEC and surface potential delisting penalties. Later on, the SEC uploaded its list of Chinese companies facing delisting from US exchanges under the Holding Foreign Companies Accountable Act, which was paired with increased COVID cases as well, which had resulted in lockdowns. So the macro environment underwent a shock as the lockdowns intensified and the economy slowed down, resulting in GDP misses and decreased investor confidence. Here's where we began to see the Nasdaq Golden Dragon China Index, also known as the HXC, sustain significant losses, reaching 8-year lows mid-March. So lastly, we saw hints of the tech crackdown easing in Beijing, bringing back some positive sentiments into space, as well as the improved audit rules, leading us to the second half of 2022, along with reopening of major cities as COVID lockdowns came to an end. So once we saw some recovery in positive sentiment, the HXC gained 40% since year-to-date lows in March. In comparison, we see that the S&P 500 has increased by about 16% from year-to-date lows, and the Dow Jones up 12%. So all of this just indicates that the HXC has experienced a stronger rebound in comparison to the US counterparts.
How does China's economic landscape compare to other developed countries, and what are some key opportunities in this space currently?
Sure. So we want to take a look at three things. So first is monetary policy, and China is currently in the stable to easing stage of its monetary policy, meaning that the central bank is lowering its rates in order to stimulate growth in the economy. This presents an opportunity in the investment landscape as lower rates encourage stronger gains in the market. And in comparison, developed countries such as the US and some countries in Europe, they're tightening their monetary policy and engaging in quantitative easing, making the investment conditions not as desirable. Second, we take a look at fiscal policy. So China is presently expanding its fiscal policies in order to influence the nation's economy after the shock we saw throughout the first half of 2022. Taking a look at the developed countries, particularly the US and Canada, we see that the government is reducing spending levels and tax rates after its 2 years of related COVID stimulus. Lastly, and this is what I believe may be the most important, is the overall stage of the economy that we're in. So China is in the early recovery stage of its economic cycle, whereas Europe and North American countries are entering into the late stage of the cycle, also known as a recession. And this presents opportunities in the Chinese space because during an economic recovery, we will see increased spending and overall consumer and business confidence, resulting in higher performing markets. This is important to note because the current North American space may be frightening at the moment with not a lot of room for opportunistic gains. Therefore, investors can look elsewhere to develop their portfolios.
How has this impacted the investment scene? Are there any particular trends that we see among top market movers?
Yes. So overall, the first quarter of 2022 was largely characterized by one overarching theme, where we saw asset managers moving away from the technology and consumer cyclical space. So we ran an analysis on the top active money managers in the space in terms of largest dollar exposure to China, and we analyzed this data based on SEC filings such as 13Fs. So what we noticed is that players such as JP Morgan Asset Management, Goldman Sachs, and Coatue Management all steered away from the technology and consumer cyclical sectors, where the common theme was a pullback from large cap software and IT services space and large cap diversified retail and hotels and entertainment. Other asset managers such as BlackRock, Fidelity Management and Research, and UBS Asset Management see the opposite taking place, where they are investing into the technology space, largely increasing their holdings in the large cap software and IT services names. So that was for the first quarter of 2022. And now we take a look into the passive money flows year to date. And we see that January was largely categorized by inflows through ETFs, such as iShares China Large Cap ETF and CraneShares CSI China Internet ETF. During March, where we saw the HXC reach 8-year lows, multiple China-focused ETFs saw a large pullback in dollars invested, which continued onto the following month. Once the market conditions in China began to improve, these ETFs saw large inflows throughout the June, particularly through funds such as iShares MSCI China ETF and CraneShares China Internet ETF. So this is essentially all to say that although passively managed, China-focused ETFs painted a clear picture where we saw weaknesses and strengths in the Chinese market, which will likely translate into asset manager movements in the second quarter as well.
What are some themes we can expect to see in the Chinese landscape in the near term?
So in the near term, China is focusing on improving its economic landscape in order to regain consumer and business confidence and develop its overall economic output. So this forecast is largely categorized by the following key developments. Firstly, COVID cases are slowing down in order to combat potential resurgences in the central government. And the central government has adapted its 19 COVID policy into a dynamic zero COVID policy, which is essentially a transitional strategy to control the spread of the disease rather than eradicating it completely. And this ties in well with the second development, as it was created in order to combat supply chain issues, where we can expect steady improvements in the supply chains as 2022 progresses. Lastly, Beijing is beginning to introduce economic stimulus and policy reforms. And not only does it signal government support for the economy and large businesses, but it also provides a sense of reassurance to the general population and smaller businesses, boosting overall consumer confidence. Here is where we can expect to see enhanced tax refunds, social security contribution deferments, and increased credit for smaller businesses.
How can we expect the investment landscape to change moving forward, given what we saw in the first half of the year?
Yes, so given the first half of the year, the goal is to not repeat the same mistakes and provide leeway where possible. This is the expected improvement of supply chain issues resulting from proactive and the transitional dynamic COVID policy paired with economic stimulus is anticipated to increase asset flows into the consumer cyclical space. Further, given the fact that China is in the reopening stage of the economic cycle, we can expect increased investment into the sector. Furthermore, the policy reform, with particular reference to the aims to promote the sector's development and alleviate investment concerns, making the investment conditions more desirable and bringing more money into the sector and the economy as a whole.
And finally, Klea, what are some things we need to look out going forward?
Yes, so although China has restored some confidence on a global perspective of how it aims to deal with potential COVID outbreaks, we still need to tread with caution. Subsequent waves could hinder the impact on the economic recovery. However, it appears that the country's approach regarding lockdowns and widespread testing are becoming less disruptive to the economy in comparison to what we saw earlier this year in Shanghai and Beijing. The financial stability in the property sector is still an ongoing problem, where multiple developers continue to face the risk of default. In addition, mortgage repayment failures need to be monitored, regardless of the government stepping in to provide aid. Although increased government spending on infrastructure is expected to have a positive impact on the housing and consumption as the industry reopens, this is something we need to approach with caution. And lastly, we are currently experiencing tensions between the US and China in regards to Nancy Pelosi's visit to Taiwan, where Beijing retaliated with military drills against the island. Although there may be some lingering repercussions here, depending on the situation's progression, it is not immediately damaging to the asset managers due to the overall state of China's economic landscape. Although a hot topic, Chinese stocks are not particularly taking a hit as the HXC has recovered, giving us some hope that the impact will be short-lived.
All right, Klea, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great, thank you so much.